And thanks everyone. Bryan Monteverde with Divorce Outcomes. Many of you I know, a few of you I've talked to outside of this group, so you probably have a sense of what we do, but I'll just start with kind of an overview of our niche in this market. So our firm, Divorce Outcomes, actually derived from an M&A transaction back in 2002, where the husband and the wife were also going through a divorce. So naturally, there's a lot of complexities going on there, a lot of variables at play, a lot of hair on the deal, if you will. And it was hard to make sense of it all. And so we came in as a firm and started figuring out, okay, it's interesting to think about divorce in terms of an M&A, because the reality is a divorce is an M&A. It's very much akin to an M&A in that 90 to 95% of the issues that people are dealing with in a personal divorce are financially related. And you're essentially separating an asset, whether it's a business estate or marital estate, into two. And so what you need are financial frameworks and processes to help you get from point A to point B, with the objective of really maximizing and protecting that wealth at risk and maximizing the financial position that you're in afterwards. So that's what our firm does. We're not attorneys and we're not wealth managers. We're very much specifically focused in this niche of resolving the uncertainties of people going through a divorce, whether it's shareholder dispute or a personal divorce for a business owner, and giving them clarity and helping them understand what those long and short-term economic implications are to themselves, their family, and their business, and all the stakeholders involved in the business. And then we actually help them architect a solution very much akin to a settlement structure or a buy-sell agreement to actually effectuate that transfer. So like I said, we fit in this unique space. We're very intimate. We have a lot of intimate knowledge as it relates to exit strategies. So we understand the minutia and the details that go into and the complexities that go into a business transaction, which is especially important if you have a business owner who's thinking about and or going through a divorce at the same exact time as the transaction. And as we all know, there's sort of two sides to the coin. One is the divorce could dismantle or disrupt the likelihood of the transaction happening, or even worse, in a lot of cases, the divorce forces a liquidation of the business because they couldn't find a resolution outside of that, right? They couldn't come up with the liquidity or come to a negotiation or structure the deal in a way that would protect the business. So we kind of fit in this space between personal and corporate finance. We call it divorce finance, more specifically divorce economics. And so we're jumping into this from the traditional view of accounting, which is a lot of ways people usually approach divorce, which is assets minus liabilities is your net equity. So let's go ahead and split that up. We fundamentally view it in a little different, from a different perspective, in that assets plus liabilities and future commitments is your total wealth at risk. And what's so critical in the process, which is almost entirely skipped altogether in a divorce proceeding or divorce process, is that they don't properly define and profile the marital estate. So it's a major step. They won't set the parameters of that estate, the business estate, and the marital estate, and define what that wealth at risk is, and all the individual tradable components within that estate that need to be brought to the surface and discussed and traded off for. Certainly, hidden liabilities make up the vast majority of this, both inside and outside of the business. But if they're not brought to the surface, what often happens is they're inadvertently put in your individual estate at the end of the day, and you realize you have far less wealth. By doing that, you create a lot of financial constraints for yourself as a business owner. So just high level, and there's a lot of risks that we can talk about all day, but just a few that we come across quite often. And this isn't necessarily specific to an exit strategy, but it can very much be applicable to it. So you have the entity structure, the business credit risk, the business valuation is a major one, and we'll talk about that. The tax, the spousal support, and how that kind of ties in. Actually, even on a higher level, the capacity for earnings and the needs. So your discretionary, non-discretionary spending, and then your business partner. How's your business partner, your equity partners impacted by the divorce? Certainly, they're going to be worried if you're in business with someone and you share 50% ownership, and your partner is going through a divorce, you're probably going to be pretty worried, because there might be a likelihood that the outside spouse comes in and starts to manage that business. And that's something we see quite often if it's not dealt with correctly. So entity structure, we get calls all the time from business owners with all these questions, like what entity structure is best for me? Should I change the entity structure before the divorce? How does the operating agreement impact my divorce? And how do you structure the transaction to address these risks? When I say structure the transaction, I actually mean structure the personal divorce, not so much the business transaction. Although you want to structure them properly, right? You want them to align together, especially when it comes to spousal support, and when it comes to risk allocation of the business. You take, an S corp and you sell it, and it's an asset sale, and you get left with a lot of legacy liabilities. If that's occurring during your divorce and those aren't brought to the surface, those are going to impact your wealth as a business owner after you get divorced. If you don't acknowledge those liabilities or address them within that divorce, you might get stuck with liabilities inadvertently that you have to pay for now, that are going to deplete your wealth and put you at risk. So all of this needs to be thought through pretty methodically to determine, what is the best entity structure. Now, this is an unfortunate issue with divorce, is that there's a lot of process level with divorce, and that once you enter into a legal and, the legal process and file for divorce, you do diminish maneuverability. It's a very dangerous time and risky time in your life, especially as a business owner, because, your assets are for the most part frozen. You diminish maneuverability. Just a lot more advisors, attorneys kind of watching over you, and it becomes really, people describe it as if my life has been on hold, essentially. And so addressing these issues before the divorce is just so critical. So business credit, again, a lot of risk here. Just it's about managing it. The liquidity in divorce is a major factor, right? If you lose liquidity, you're forced to sell things to create liquidity. Oftentimes it's the simplest way. People view it as, let's split everything 50-50, no questions asked. If you can't pay the other person, sell it off. Sell off the home, give them half the cash. Sell off the business, give them half the cash. Fire sales of a business caused by divorce is fairly common, actually, especially on the smaller size businesses. So from a credit standpoint, is that going to impact my ability to borrow money, right? Your essentially your collateral pool just shrunk in half on a personal side. So if you have a recourse loan or personal guaranteed, that's going to impact it, right? You have to work with the bank and kind of manage those. Even on a personal divorce, it happens all the time. A spouse will leave the household, take over the mortgage, and realize I can't get financing from my bank because I don't have established credit or I don't have reoccurring income. These are all things that need to be brought to the table at the time to manage. And will I be restricted, right? You have to think through these issues and how you're going to finance these. So business valuation, I mean, I could sit here and talk for 10 hours about this and how, we see the horror stories all the time. Between myself and my colleague, we have over 40 years of valuation experience, and we all know on this call how subjective it can really be. Ideally, a buyer's going to, when you get a business valuation, you want to look at it from the buyer perspective of the buyer, right? To really identify what those risks are and what a business is actually going to sell for. We were in a situation not long ago where there's two couples in a mediation, business owner. They went out and got individual business valuations, and one was sitting at about 3 and the other one was sitting at about 8. So you have these two wildly different valuations. No one within that sphere was really looking at the economic grounding of those valuations, but at the end of the day, the mediator threw them both out. So now they're at square one, trying to figure out, okay, how do we deal with this business now? How do we separate it? So does it impact the outcomes does the data valuation impact the absolutely. I mean, COVID was a major one, right? At the beginning of COVID, you might have found a way to lower your business value to 10 million. And then all of a sudden COVID's over and you're like, well, it's normalized now. You can play with those numbers all day long. I mean, and then what does that lead to? It just leads to a lot of litigation, and it doesn't really, it brings those negotiations to an impasse. So we look at really the economic grounding of all these business valuations and try to break it out into those tradable components and really say, okay, well, we have a business here. It's the primary driver, economic driver of a family unit. So how do we satisfy everyone's needs in this? Let's forget about the value for a second. How do we satisfy everyone's needs with this business? And most importantly, protect the business through the divorce, so that you're not disrupting the business as a going concern. Can I dispute my business valuation? Oftentimes it's not disputed, or it's disputed in the wrong way. So you should ensure that the valuation makes sense. We had a situation a couple of years ago where it was a service industry, a single service provider, consultative firm, and a third-party valuation firm in California decided to say, well, this firm's about 80% in enterprise goodwill. And so as we analyzed it and got closer and deeper into the business, we realized, well, that valuation professional was entirely wrong, because as soon as this individual leaves the business, there's nothing in the business. There's no proprietary processes or uniqueness to the business except for this person who had all the knowledge. So there was really no enterprise goodwill or personal enterprise goodwill at all. It was all personal goodwill. So needless to say, he was pretty negatively impacted because of that particular situation. You have the double dipping issue. Obviously, that's a high concern. As a business owner, if you pay out half on the business, you're left managing the business. You're left with all the risk. And so you really have to manage that. You have to manage the risk, really. It's who's taking on the risks and who's benefiting from those risks. Tax, obviously, tax basis of the business is a huge matter. How are things being sold? Is it better to do before or after the divorce, during the divorce? Who's taking on the tax liabilities? Are there tax assets within the business that are of benefit? Those are assets that are going to benefit someone potentially in the future. So how do you negotiate those? So all the tax benefits are obviously huge. We talked about spousal support, especially big if the revenue is seasonal or unpredictable. Again, you don't want to put financial constraints on yourself as a business owner that are going to inhibit your ability to manage that business. It's going to be very difficult if the financial constraints are so tight on you that it's actually impacting the business. From an exit standpoint, is it an all cash deal? Is it being paid out over time? What's the riskiness of it being paid out over time? That comes into play a lot, and I could talk about that all day long too. But if you create an annuity structure, or you have contingent risks in the business still from a transactional structure, it's really going to impact you if you pay out now on that business to your ex-spouse, and now you're living that risk. So something that you really have to align properly is how that spousal support is being constructed and how that transaction is being constructed. They have to align, because if they don't, it could create some real issues for them. So that's pretty much it. I don't know how long I went, Tom, but hopefully I didn't go over. I'll leave some room for questions, and hopefully that was sort of a high-level overview of the things we think about when, certainly the things a business owner should think about when they're going through a divorce and when they're close to a transaction.